Have you ever wondered how the wealthy build their fortune? The secret is simple yet profound: investing. The beauty of investing is its power to transform a modest sum into a significant fortune over time. The key is to let your money work for you, not the other way around. One of the most popular ways to invest is through stocks. When you buy a stock, you essentially become a part owner of that company, sharing in its success. Imagine owning a piece of Apple, Amazon, or Google, and reaping the rewards as they continue to innovate and grow. But like any venture, investing in stocks comes with its own set of challenges. It's not just a game of luck, but a test of patience, resilience, and strategy. So what's the secret to successful stock investing? Let's unravel it. First things first, what exactly are stocks? Well, let's dive in and demystify this financial term. In the simplest terms, stocks represent ownership in a company. When you buy a stock, you're essentially buying a small slice of that company. Now, you might be thinking, why would I want to own a piece of a company? That's a great question. When you own a stock, you become a shareholder, which means you own a share of the company's assets and earnings. You're not just an onlooker, but a part owner of the business. It's like having a stake in a restaurant or a small shop. But in this case, it could be a multinational corporation, a tech startup, or any other type of company that's publicly traded. Now, why do companies issue stocks? Well, companies issue stocks to raise capital or money for various reasons, perhaps to grow, innovate, or even pay off debt. And in return for this capital, they offer a piece of their business to investors. The fascinating part about owning a share of a company is the potential for financial gain. If the company you've invested in does well, the value of your stock increases. For instance, if the company launches a successful product, its earnings might skyrocket, and as a result, the price of your stock could go up. And if you decide to sell your stock at that higher price, you make a profit. But remember, the opposite is also true. If the company doesn't perform well, the value of your stock may decrease. That's why it's important to research and choose wisely before investing. It's also worth noting that some companies pay dividends to their shareholders. Dividends are a portion of the company's profits distributed to shareholders, usually on a quarterly basis. This is another way stocks can provide a return on your investment. In essence, buying a stock means buying a piece of a company, hoping it will grow and make you money. Stocks offer a way for everyday people to participate in the financial achievements of businesses, making the world of finance not just for the Wall Street elite, but for anyone with a little spare cash and a willingness to take calculated risks. Now you may be asking, why invest in stocks? Well, there are a multitude of reasons why investing in stocks can be a smart move. Let's delve into some of the key benefits. For starters, there's the potential for high returns. While other forms of investments, such as bonds or savings accounts, often offer lower risk, they also typically provide lower returns. Stocks, on the other hand, present an opportunity for significant growth, particularly over the long term. If you pick a successful company whose value increases over time, your initial investment could multiply many times over. Next, we have dividends. Some companies distribute a portion of their earnings back to shareholders in the form of dividends. This can provide a steady income stream on top of any potential profits made from selling the stock at a higher price than you bought it for. Not all companies offer dividends, but those that do can provide a nice boost to your investment earnings. Then there's the matter of ownership. When you buy stocks, you're buying a piece of the company. This means you have a say in its direction by voting on certain corporate decisions. It's a way of having your own stake in the business world, and who wouldn't want that? Of course, it's important to remember that investing in stocks isn't without its risks. The stock market can be unpredictable, and there's always the chance you could lose your investment. That's why it's crucial to do your research, consider your risk tolerance, and possibly seek advice from a financial advisor. But despite these risks, the potential rewards of investing in stocks, the high returns, the dividends, the ownership, can make it a worthwhile endeavor. The key is to approach it with knowledge, patience, and a well-thought-out strategy. Investing in stocks can be a powerful way to grow your wealth over time. It's not a guarantee of riches, but with careful planning and a little bit of luck, it could be a path to financial growth and security. Getting started with stocks is simpler than you might think. The first step is setting up a brokerage account. This account is like your gateway to the stock market. It's where you'll deposit your money, buy and sell stocks, and hopefully watch your investments grow over time. There are numerous online brokers to choose from, each offering different features and fees. Some cater to beginners with user-friendly interfaces and educational resources, while others appeal to more experienced traders with advanced charting tools and a wider range of investment options. Once your brokerage account is set up, the next step is to fund it. You can typically transfer money from your bank account directly into your brokerage account. Remember, only invest what you can afford to lose. The stock market can be unpredictable, and while there's potential for high returns, there's also risk involved. Now, before you dive into buying stocks, it's vital to do some research. Start by identifying companies you're interested in. These could be businesses you're familiar with or sectors you believe have strong growth potential. Look at their financials, read up on their business model, and check out some analyst reports. After you've done your homework and decided on a stock to purchase, it's time to place an order. You'll need to decide how many shares you want to buy and at what price. There are two main types of orders, a market order and a limit order. A market order buys the stock at the best available price, while a limit order only buys the stock if it reaches a specific price you've set. Finally, it's time to hit that buy button. But remember, investing is not a one-and-done deal. It's important to regularly review your investments, keep up with market news, and adjust your portfolio as needed. Once you've set up your account and chosen your stocks, you're ready to make your first purchase. Just remember, investing in stocks is a journey, not a sprint. It's about building wealth over time, not making quick cash overnight. Happy investing. But remember, with investing comes risk. It's a simple statement, but it's a crucial one to understand. Risk in the context of investing refers to the possibility of an investor experiencing losses in their investment. It's the uncertainty that the returns you expect may not materialize. Just like when crossing a busy street, you wouldn't do so without looking both ways, right? Well, investing is not much different. You need to understand the risks involved and take steps to mitigate them. So how can you do this? Let's introduce a key concept here, diversification. Picture this, you're at a buffet. There's a smorgasbord of dishes in front of you. You wouldn't just load your plate with one type of food, would you? Similarly, in investing, you wouldn't want to put all your eggs in one basket, that is, investing all your money in a single stock. Diversification is the practice of spreading your investments around so that your exposure to any one type of asset is limited. This strategy can help reduce the risk of your overall portfolio. Imagine having a portfolio composed of only tech stocks, and then the tech industry takes a hit. Your entire portfolio would likely suffer. But if you had diversified your portfolio to include healthcare, utilities, and other sectors, a drop in tech stocks might be offset by gains in these other sectors. Diversification isn't just about investing in different sectors, though. It's also about investing in different types of assets: stocks, bonds, real estate, commodities, and more. This helps ensure that if one asset class struggles, others might perform well and offset potential losses. It's worth noting that while diversification can help manage risk, it doesn't entirely eliminate it. Every investment carries some level of risk. However, by diversifying, you're not just relying on the success of one investment, you're spreading the risk across multiple investments. Diversification is your best defense against risk. So when you're building your investment portfolio, think of it as a well-balanced meal with a mix of different assets. Bon appétit. There's more than one way to invest in stocks. That's right. Just as there are many paths to a destination, there are also various strategies to grow your wealth in the stock market. Let's discover some of the most popular ones. First off, we have value investing. This strategy is like hunting for hidden treasures. Value investors look for stocks that they believe the market has undervalued. They buy these stocks at a lower price with the hope that the market will eventually recognize the company's worth, pushing up the stock price. This style of investing requires patience and a good understanding of a company's fundamentals. Next up is growth investing. This strategy is all about potential. Growth investors are on the lookout for companies that display signs of above-average growth, even if the share price appears expensive in terms of metrics like price-to-earnings ratios. They're betting on the company's future earnings and are willing to pay a premium for it. This approach can lead to high rewards, but it's not without its risks, as growth stocks can be more volatile. Finally, let's talk about dollar cost averaging. This is a strategy that involves investing a fixed amount of money in a specific stock or market index at regular intervals, regardless of the share price. This approach takes the guesswork out of investing and can help reduce the impact of market volatility on your investment. It's a strategy that favors consistency and discipline over timing the market. Remember, these are just a few of the myriad strategies that investors use. Others include dividend investing, momentum investing, and even socially responsible investing. Each strategy has its own set of advantages and potential drawbacks. The best strategy depends on your individual goals and risk tolerance. Your financial journey is unique to you. So, take the time to understand these strategies, assess your own risk tolerance, and set clear financial goals. That way, you'll be able to choose the investment strategy that best fits your needs. And remember, investing is a long-term game. Patience and consistency are key. And of course, investing doesn't end after buying stocks. Just like a gardener who plants seeds and tends to them regularly, an investor also needs to nurture their investments. This means keeping a close eye on your portfolio. Your portfolio is your garden plot, and the stocks are the seeds you've planted. You wouldn't leave seeds unattended, would you? The same applies to your stocks. Investing is not a set-it-and-forget-it kind of deal. It requires regular monitoring and adjusting. But don't worry, you don't need to check your stocks every second of every day. It's about establishing a routine that works for you. Some people check their portfolio daily, while others do so weekly or monthly. Find a rhythm that suits your lifestyle and stick to it. Monitoring your portfolio involves more than just looking at the numbers. It's about understanding the bigger picture. This includes staying updated with company news and market trends. Is the company you've invested in launching a new product? Are they facing a lawsuit? Such events can significantly impact your stock's value. Understanding the market trends can also help you make informed decisions. If tech stocks are on the rise, you might want to consider investing more in that sector. If there's a downturn in the real estate market, maybe it's time to sell some of your real estate stocks. But remember, investing is not about reacting to every single market fluctuation. It's about making strategic decisions based on thorough research and understanding. Another crucial aspect of keeping track of your investments is adjusting your portfolio when necessary. Your investment goals might change over time. Maybe you're planning to buy a house or you're nearing retirement. In such cases, you might need to rebalance your portfolio to align it with your current goals. So, to sum it up, keeping track of your investments involves monitoring your portfolio, staying updated with company news and market trends, and adjusting your investments as necessary. Remember, investing is a journey and not a destination. So, are you ready to start your investing journey? We've covered a lot of ground today, and I know it might seem overwhelming at first, but remember, every expert was once a beginner too. Let's take a moment to reflect on the key points we've discussed to ensure you're well equipped to start your journey in the world of stocks. Firstly, we delved into the basics of what stocks are. They represent ownership in a company and allow you to partake in its successes and sometimes its failures. Buying a company's stock is essentially buying a piece of that company's future. Next, we explored the question, why invest in stocks? The simple answer is the potential for growth. Stocks have historically provided a higher average return than other investments despite their volatility. They offer a way to grow your wealth over time, building towards financial goals and security. Then we discussed how to buy stocks. Remember, it's not as intimidating as it might seem. With a brokerage account, you can purchase stocks easily, but remember to do your research. Look at a company's performance, its future prospects, and its current market position before you invest. We also touched on the importance of understanding risk and diversification. Not all stocks are created equal, and it's crucial to build a diversified portfolio to spread your risk. Don't put all your eggs in one basket, as the saying goes. We also explored different investment strategies. Whether you choose to be a passive investor, following the market trends, or an active investor, picking individual stocks based on research, is entirely up to you. Your strategy should align with your financial goals and risk tolerance. Finally, we discussed the importance of keeping track of your investments. It's not enough to just buy stocks and forget about them. Regular monitoring allows you to make informed decisions and adjust your strategy as necessary. With knowledge and patience, you can make the stock market work for you. Remember, investing is a marathon, not a sprint. Don't be discouraged by short-term losses. Instead, focus on the long-term potential and the power of compound interest. Happy investing.